All right, okay, we are live again. Welcome to another show. We got plenty of people joining us right now. So if you can hear me well, give me a thumbs up so I know you're there and you can hear me. Today we have a special guest, author of Trading, Profiting as an Active Trader, Mr. Brian.
There you go.
How you doing?
Good afternoon, good evening, good morning, everybody, wherever you are. Happy to see everyone here. Welcome to the room. We're gonna do the closing bell as usual. They're the last 30 minutes here of the trading day. Just have a little discussion about what's been going on. And yeah, we've had quite the comeback in the market here. I'm just looking at some of the charts. Bitcoin, crazy as usual. It was really in the red quite a bit of the day, and now it's just blasting higher. It's back through 20,000 again, and the Qs are actually green on the day. So there you go.
Yeah, I was telling Andrew last week, I think for the second half of the year, Qs are gonna outperform SPY. They might both be red, they might both be down, but I think in terms of relative performance, I think Qs will outperform just because of the interest rate on the long end is coming down, right? The 10-year and the 20-year. So that kind of helps the technology sector and the Qs.
Yeah, no, I agree. I think if you just look at the performance of the Qs over the last week or so, it's it's been down the most when we've had bear market activity, but as soon as the market turns a little bit, the Qs lead the way higher, and some of these growthy stocks are probably going to be performing fairly well, at least the best in the bunch for the remainder of the year. I agree with you.
Yeah, so it's interesting that you mentioned that. So I'm at trading terminal right now at a 1 week performance, and for the week, Qs is down about the least out of everybody. So only down 1.27%, IWM 1.5%, and then a SPY is down the most at 1.68. So we got a packed show today. We're talking about JPMorgan, Morgan Stanley. The banks had their earnings. I did some research and put some work in there until our developer. Yeah, there we go. I did some research. We're gonna get to the nuts and bolts of it. The Bank of Canada, Brian, raised by 1%.
Yeah.
That was insane. Yeah.
That was crazy. I don't think anybody actually anticipated that. That was a bit of a shocker.
Yeah.
And as being someone who has a mortgage, that wasn't great.
No, definitely. Yeah,
we were a variable rate one too. So.
Yeah. So actually, today at lunch, I was talking to one of my friends. He's also working in banking, and he was telling me, one of the difference Canada has with US is a lot of us have that variable mortgages. So we have to renegotiate. Yeah. And with the stress test, what's going to happen to the housing market in Canada?
I think if you look at housing, if you look at the housing statistics right now, I think you're definitely seeing a slowdown. A lot of places. I think it's happening across the U.S. as well. So I think the reoccurring theme here, I think in this inflation story is high prices. High prices are a good remedy for high prices, right? A lot of the commodities have all pulled back. There's a lot of things that high prices have really impacted, and so maybe this is going to help cool demand and bring inflation down.
Yeah, I love what you said. A remedy for high prices is high prices.
Yeah.
And that is so true. When things get so expensive, people are like, I'm not going to shop anymore. I'm just going to... Yeah, definitely. So on the topic of market, SPY barely going green. Nasdaq's already plenty green. It would have been an amazing trade. You did catch a nice reversal on TQQ, I believe. Let me bring up the chart. If I'm not mistaken, you did trade TQQ this morning.
Yeah, we did. We traded that. I'm trying to remember. I did a few trades, but yeah, we got a nice move out of that. And it was a little, obviously it was a little volatile till about about 1:30, and then we really started to break higher. But yeah, no, there were some good trading opportunities this morning, and I'm I guess hoping that other people saw some of those opportunities as well.
Yeah, definitely. I mean the Qs, especially the Qs were pretty strong. and hopefully people in the chat were able to trade. One of the trades that I did that I want to talk a little bit about it, and before we get into the details of the show, was Morgan Stanley, and this is your signature trade, and I want to talk a little bit about this. Let me bring up the chart for it. Let's go to the daily here. Get our charting.
Yeah, it was interesting. Morgan Stanley and JPM obviously put in some numbers this morning.
Yeah.
And I guess it was kind of a mixed review, although the market didn't like it very much. But I don't think their numbers were that bad.
No, they weren't that bad, and we're going to talk about them in details. But yeah, they weren't that bad at all. I 100% agree with you.
Yeah.
I think overall people were really nervous how much loan generations is slowing down, how much bad debt expense there is, but it wasn't as bad. But I got the Morgan Stanley chart up, and I think this is really good because this is one of your signature trades. So the stock, slightly down after earnings, and then throughout the day did this really clear hammer doji, signaling that okay, there is some strong support and strong buyers here. And one of the things that you and I both love to do is selling premium right around here. So this is right after the earnings. Implied volatility IV is still really high.
Pretty high.
Yeah, so you can get something. So right at the 68, right at that support level, I sold bunch of puts that are going to expire tomorrow. It's going to be another extra $300 for the week. I'll take it. In this inflation, I'll take it.
Yeah, no, it's a strategy that been using for a while now. Yeah. As you know, with after earnings. I mean, some people will trade options going into earnings. I know a lot of people do strangles and straddles. Somewhat, making a bet that you're not going to get too much of an outside move. One way or another, so they used the implied volatilities and standard deviations to try to figure out where to put those, to buy those puts or sell those puts and calls. And but this, I like this because it's a little more, it's a little you have your ability to control your risk a little bit better.
Definitely.
Whereas going into an earnings report, I know people that have written puts and calls, and then you get like this wipeout outside move, and you're so in the red on that one trade. It's painful. So this is a much easier way to control your risk.
Yeah, definitely, especially after the earnings, because if you got those crazy gap ups and gap downs, then there's nothing you can do. Option market is closed. You just have to sit on it and wait for it, or you'll get a sign, and that's not ideal.
Yeah, I did that. If you want to bring up Boeing, I did a put sale on Boeing when it was it just again, I like the. They had some good reports on their plane deliveries for June and some new orders, and they were really trading down at that time. Yeah. They popped up a little bit, but there was still some good implied volatility or premium in the options. So I sold some puts right where it has been previously finding some resistance, and so they're going to expire. Today as well. Definitely.
So I got the charts here. So again, right around this 130, a couple of times has been tested. 1 time, 2 time, 3 time, and then this was the kind of the news that I believe rallied this up. So selling some premium, selling some puts. Obviously, all you're betting on is that the stock is going to close above this strike price. You're not really betting on the crazy direction or a massive move up. You just want to contract some premium out of the market, which by the way, currently with VIX being at 26, it's a great time for premium sellers. They're having a really good time. Yeah. So another crazy day. This morning I was talking to Andrew, and he was very nervous. He's like, "Oh, market's down. What's happening? For his long-term portfolio." And I told him, "Hey, you just got to sit on it, right? You can't time the market. And look at it. The market is now green." IWM still kind of the weakest indices of them all. But yeah, the market's turning green. So let's get started. Let's talk about our agenda today. Yesterday, by the way, for anybody that tuned in, we had Dash on, Brian, who's one of our members and joined Peak Capital Trading. He shared his cumulative R. I believe I have it up here as well. So he came in, he shared some really personal stuff, and this is kind of his R R-curve. He was really successful after the boot camp, being really consistent. Nice. He was, generous enough to share his story. It was an amazing session. If you haven't checked it out, make sure to check that session out. But we're going to talk about U.S. mortgage. We're going to talk about the rental, the housing market a little bit. We'll deep dive into JPMorgan and Morgan Stanley. We'll take a look at some interesting data. And in the world of Twitter, Bill Ackman went on a series of tweets yesterday that we're going to talk about that as well. Jobless claim is starting to tick up. The numbers came out today. Any surprise there? I know Google and Microsoft are both slowing down hiring. Any surprises there for you, Brian?
Not really. I mean, you are seeing headline news or second down headline news of companies either doing hiring freezes, a few doing some layoffs. So there's no question things are slowing down, cooling off a little bit. I was listening to some data just on the way over here. There was this All-American census stuff, and they're talking about some of the concerns that people are having and how they're reacting. So they did a study about what a consensus or a census on what people are doing right now, and so. Some of the things, a lot of people are cutting back on going out to dinner, all the discretionary spending. I think it was like 35 or 40% of the people were saying they're cutting back on their discretionary spending. So, and there was a raft of data that all supported the idea that things are starting to slow down and people are cutting back. People said that, I think it was about 50% said they weren't going to they weren't planning on traveling, or they're cutting back on their travel. Yeah. So that, after we've seen this big surge in travel and everybody's seen all the craziness in the airports and stuff like that, I think, that was a
peak.
That was a sort of a peak where, everybody's been waiting to travel, and now they're all getting it out of their system. They're going to visit family that they haven't seen for maybe a couple of years. And, once we get through that, I mean, it does sound like things are starting to slow down a bit.
Slow down a little bit, and hopefully that will slow down the Fed.
So this isn't surprising to me. I mean, I think in the general context scheme of things, I think the numbers we've been seeing with the high CPI numbers and year-over-year increases, I think they're going to probably cool off.
Yeah, so it's interesting because you mentioned travel. You know how the euro and USD is in parity right now, so it's a great time to travel. And I said it in our group chat, and Norm was like, yeah, the euro and USD is 1-to-1, but the plane tickets is a lot expensive. So things are still expensive. One last thing I wanted to add, and this is the courtesy of Michael Cantro. He's a investment banker and a chief strategist. He has this framework called HOPE, and I think it's really important on the topic of employment. And he says basically, in order to realize what is leading and what is lagging, always remember HOPE. And HOPE, H is the housing, so it always starts with housing. What is the NHMI report? What is the HMIA index? What are those telling you? Then it goes into orders. So look at the ISM, look at your PMIs. Are there new orders coming in? The P is for profit, so that's you look at the financial statements and the earnings season, and the E is employment. So this usually happens at the very end in the framework. So it starts with housing always, it starts with ISM and new orders. It leads into profit, into the income statement of the Q2 that we're looking at right now. And then the last thing is the employment. So don't let these still very low employment fool you to think that, hey, the market is done or the selling is done, right? There might be still more pain ahead. You have to look at leading indicators. So I thought this is pretty interesting. I wanted to share it here as well. By the way, someone in the chat said, appreciate the product placement. I didn't know Brian wrote a new book. Well, now you know. This is why we do this. Yeah. How's the new book doing, by the way, Brian?
I think it's doing okay. Got some good reviews so far. So we're just working on the audio version of it now. I've hired a guy to narrate it, and he's working away on it, and he's committed to have it done by the end of the month here. So we'll have an audio version out here shortly.
That's amazing. I know a lot of people love to listen to audiobooks during the run, so that's amazing. Shall we get into earnings?
Yeah, let's do it.
So these are the nuts and bolts of JPMorgan earnings. So I did some research. One of our analysts that works with us also did some research. So they're reducing share buybacks. So share buybacks would be significantly reduced to build capital for increased requirement. Spending is still healthy. So spending is still up about 15%, but remember, we have about an 8% inflation. So in terms of real spending is only slightly up at about 7%. So you have to take that into consideration. Of course, there was a massive miss on earning per share, and I'll talk about why that happened, and also a massive miss on revenues. Have not observed any pullback in discretionary spending. Travel and dining grew 34%, obviously, and spending is growing faster than income. So this kind of showcased the inflation. A couple of things that I wanted to show from their filings, and this was really important, and I think this kind of led into the sell-off, especially for JPMorgan, is prior to earnings, I said two things you want to look at. You want to look at loan generation, and then the second thing you want to look at is the bad loss expense, the provision for bad loss. And you can see provision for credit losses has actually increased. So about 1 billion here. These numbers are in thousand when you compare it with last quarter. Another thing is over here, again, on the consumer side, you will see this really vividly, really massive increase in provision for credit losses in the consumer and community banking section, up about 15%. So basically what JPMorgan is telling you is that, hey, we think economy is going to slow down enough for us to increase our provision for credit losses up to 15%. So that's kind of, it's
ominous.
Yeah, exactly. Because it's a lot of it is accounting, right? They gotta. This is just a provision. It doesn't mean that people have defaulted, but for accounting purposes, they gotta put this money aside in case there's a bad debt expense. So that was interesting. That shows it wasn't as bad as we thought, but it still shows that, hey, the earning is slowing down.
Yeah, and they're they have some concerns about their loans.
Yeah.
And the security, so they're increasing the provision for losses. That's typically what they're going to do if they think the economy is slowing down.
Yeah.
So.
Yeah, exactly. Anything you read, Brian, on the bank's earning that kind of got your attention?
That was kind of covered it. I think I kind of concur with you. I'm somewhat surprised that given that backdrop, I'm watching companies like Affirm, which is a lender. Sort of like buy now, pay later.
Yeah.
They're up significantly today. So if you're thinking that there's going to be a problem with the consumer and loan losses, I mean they're ripe for getting whacked if that happens. If a lot of their loans start to go south.
Yeah, I personally, again, not a financial advice, but despite Affirm being down, and if our producer can go to Brian's screen, I think he has the Affirm chart up. Despite Affirm being down, I think, 70%, I still think there's another 15-20% on the way down. It just seems to me that, again, as you mentioned, once the credit cycle starts slowing down, these companies are the most sensitive. The SoFi, the Affirm, these fintech names, the Square, these guys really slow down heavily.
Yeah, I mean, there is a fairly, well, no, there's not much of there is a pretty significant short on it already, about 16.5.
Oh, wow.
So not huge. Not like in the 30% range, but I mean, there are people betting against it, and it has obviously sold off significantly from $150, even higher, $175 back, back here. So or crazy. Anyway, yeah,
definitely. It's one of those things. A couple of other things a couple of little nuggets that I got from JPMorgan earning. I think it's consumer are still in good shape, so they're spending 10% more than last year, and almost 30% more than pre-COVID level, because we know a lot of stimulus went into economy, savings went up. The key things are right here, in my opinion. Home lending revenue was down 26% year over year. mortgage initiation was down about 45%, and
Wow.
we know JPMorgan let go of a lot of their mortgage department bankers. Investment banking revenue was down 53%. Of course, when the rates are going up, nobody want to do any acquisitions. Mostly, it's going to be restructuring, if anything. Lending was up, and that's kind of so the key loan generations overall were down. So that's another thing, and of course the stock gap down 4.5%.
Yep.
On the other hand, the banks also had earnings. Another bank, the Morgan Stanley, banking lending balance grew by $7 billion. So in terms of their numbers, again, missed on earnings per share because of increased cost, missed on revenue. Pretty massive miss on revenue. So
big miss.
Yeah, similar story as those guys. And again, the same thing, same stuff we talked about. The overall spending were down. In terms of loan loss provision, 413 million losses on corporate loans held for sales as credit spread widened. So that was another one of those things. Yeah. But they held up really nice. I mean, let me go to the chart and look at what is like kind of the year to date for like Morgan Stanley, or even the 1 year return. So what was this guy?
Well, it was trading over $100 earlier in the year.
Yeah.
And now it's down around 75. So
that's a 25% drop.
Pretty significant drop.
Yeah. Yeah. Let me.
Probably a little in line with what the overall market has done, but certainly a pretty significant hit.
Yeah. So it's almost going back to the pre-pandemic 2019. They were at what, like $60? It's almost going back to those areas. So he gave back all the 2020 gain, which is, I'm looking at the weekly chart right now. Gave back all those gains, which is troublesome definitely for the bank. Same story for JPMorgan.
Well, it could be. I mean, this could be an area where there'll be some support. I mean, all these pullbacks. I know a lot of fund managers are waiting for another leg down to really start to hopefully pick up some shares at discounted prices. But sometimes those secondary pullbacks never happen. So we'll see. I mean, we are into an area where there is some pretty significant support. There should be some significant support on Morgan Stanley right now.
Yeah, exactly. So this was one of those conversations I was having, Brian, is yesterday. Everyone's so bearish, right? Everybody believes that there's another leg down.
Yeah.
But usually there's an unwritten rule in markets that says when everybody's so sure of one outcome, the other outcome happens.
Yeah, exactly.
Think we could get kind of a rip your face off rally?
Well, I think we possibly could get a rally here. Again, we've got this backdrop of earnings, and companies are going to be coming fast and thick here in the next 2 weeks.
Yeah.
And if we continue to get bad news and bad guidance, I mean, it in theory could push the market lower.
Yeah.
A lot of people are waiting to hear what Apple says. Apple's up, I believe, today.
Yeah.
And a lot of people are waiting to hear what Apple says later in the month, I believe.
Yeah. The semis were so strong today. That was another surprising factor.
Well, I think that was in part due to TSM. TSM reported.
Yeah.
And I didn't actually get a chance to look at what they said for earnings, but they've, after a lot of gyrations in the first hour or two of trading, it's been pretty much trending higher all day.
Yeah.
So. And AMD was actually, I traded along with it, It was up and down, and I'm sure AMD is up today as well.
Yeah.
What's the semiconductor index?
I know the leverage one is SOXL, but I don't know the regular one.
Or SOXX, I think might be the unlevered one, but it's, the levered one, SOXL, is up 75 cents, or about 5.5% right now. So having a pretty good day. What's out of curiosity, what's Nvidia doing? I'm sure it's gone green on the day. Yep, it's up 1.5% or so. Yeah, so
crazy how volatile Nvidia is, by the way.
Yeah, but the semis are making a comeback, and I think it was partly due to TSM's whatever they had to say for earnings and guidance.
Yeah, I have to check that out. We'll probably, SMH is the non-levered one. People in the chat are saying,
there's SMH too, yes.
So I'm monitoring the chat. We got Jason in the chat, and he says, let's rip or tank just out of this range. So Jason's one of those option traders that make money when we break these ranges. So it's been really frustrating for him. We will break out of this range, man. I'll promise you. Nvidia is overvalued. How come it's a strong buy? Retta, I don't think we said it's a strong buy. We were just
commenting on how this, Nvidia, AMD, MU. Those are and to a secondary extent TSM. Those are the ones we watch for the semis. Those and the Intel, of course. Not as much lately, but we're just saying that the semis are up today, and we just got the bell. So
So Retta, I know you're in the chat and you're monitoring. So one thing I would say is one of the things that we talk about when it comes to semis are they're pure cyclical plays. Meaning when we say something cyclical, we mean that it's very sensitive to the business cycle. So with all these talks with increased rates and recession, any name that is cyclical and kind of depends on consumer discretionary and disposable income is going to have a rough time. So when you look at SMH, which is the index for semis, you can kind of see right around January when we started talking about recession and increased rate. So this whole index is down. Almost 35%, right? So down massively, and it's not just the semis. You can kind of take a look at any name for that matter. So look at Ford. Ford is an amazing company. It's trading at a really cheap multiple right now. Gave back all the gains of 2021. Why? Because it's a car company, right? So when we go to recession, people are not going to buy as much cars. So that's these things. These are kind of the macro things you want to keep in mind if you are looking at buying things for long term. You don't want to buy in a downturn. You want that trend to kind of break.
I mean, I'm looking just at the AMD chart now, the daily chart. If you want to bring that up, it's kind of interesting. From a technical perspective, it looks like it's it's ready to bounce a bit some more here. I mean,
which ticker are you looking at?
AMD.
AMD,
I mean, if you look at this, it's put in a low, and on that pullback, it put in a higher low. That's
like a cup and handle, kind of.
Yeah, a little bit like a cup and handle, or just a double bottom. If you can, it didn't quite get back to that previous bottom, but this is an indication that that buyers, the selling is done, and when the buying started, and then there was the initial profit taking, buyers were ready to step in at a higher price. To push that stock back up again. So I mean, this is a good area to watch AMD because we could push through this sort of $80 level. It seems like resistance.
No, it's very interesting. So I'm monitoring the chat as well. So Retta is saying on the website. So this is a great point that you're saying. This is based on analyst recommendation. So the analysts are saying this is a strong buy and their price target is 224. Remember, the analysts, when they give out their recommendation, their timeline is 1 year. So this is a 1 year target. So don't trade or don't buy stuff based on this. This is based on analysts. And remember, analysts have a incentive to tell you to buy something, right? Because they want to sell that research report. They can only sell it to people who don't own it. So they usually overweight on buy ratings rather than sell ratings. So you want to take their word with a little bit of a grain of salt.
Huge, big grain of salt. This is again, analysts are like all of us. They're not always right, So they make their best guesses based on what they see in the company, but often the company's performance is tied to the market. There's always that beta.
Yeah. Another thing, Brian, and I think this is really important, is after 2008, when the banks started downsizing, people who do the equity research are the same people that are working on the deals. So they're so spread in terms of hours. They're not really putting some really high quality research into these companies. So you definitely want to take a look. Indigenous Pathway is asking a really great question, saying, do you think we will see a capitulation moment with the WIX rising above 40 or 50 that might announce a trend reversal in the market? Are there any other correlating indicators that would kind of credence to this?
Well, I think the most obvious bottoming action that a lot of people are looking for is a spike in the VIX and a corresponding, capitulation sell-off where you get a real significant volume of selling flush down, and then you get that, doji candle, that reversing candle where, capitulation happened. All the people that were just holding on, hoping for a bottom, give up. And then the bargain hunters come in and drive, and that's kind of that's, I think, a lot of people are looking for that.
Yeah.
I don't know if we're going to get that, or if we're just going to. We've already sold off pretty significantly on a lot of stocks.
Yeah.
Maybe we're just going to grind along here, right?
Yeah.
Until we start to see some breaking of levels that would indicate that the stock's going to go higher, like the AMD trade we just talked about, where you get a low and then you get a pullback and you get a higher low.
Yeah.
Kind of another indication
that kind of shows that sellers are exhausted.
Sellers are exhausted, exactly.
Yeah, definitely. I mean, it's a great question, Indigenous Path. There's one thing I tell you to pay attention to if you're looking for that VIX capitulation and why it might not happen is the skew. And this is something I've talked about, and we have it in the trading terminal. So if you go to our trading terminal overview, we have this skew over here. So a skew is a reading between 100 and 150. The closest it is to 150, that means people are buying out of the money puts. So they're only hedging their tail risk, way out of the money. The closer it is to 100, it means people are buying at the money puts. So they're basically hedging for immediate sell-off. So when the skew is really close to 100, in this case at 120, this shows you that a lot of people are well hedged going into this market. So when people are well hedged, you're less likely to see that VIX capitulation because people are hedged. They're not gonna be like, oh my God, I lost everything, I'm just gonna panic sell everything.
You're gonna have to sell. You've got essentially insurance.
Yeah, definitely.
You've got downside insurance. So you're, it's like when your house is on fire and you've got insurance. You don't feel good about it, but at least you've got you're going to be covered by with your losses. So
yeah, exactly. So you want to look at that askew, and this is one of those things that really bothers me. People in CNBC especially, they're like, oh, we're not at the bottom because we haven't had that capitulation. Well, we might not have it this time around, right? This time around might be different because exactly like what Brian said, it's been such a slow grind that people started hedging. And they're like, okay, this might be a multi-year bear market or a 6-month, 7-month bear market. So people started hedging early. VVIX is at 2-year low. No one's. Yeah. Jared is in the chats. Reda is asking, so consumer cyclicals need to be avoided at the moment. Yes, I would suggest don't touch cyclicality right now. Yeah.
No, I mean if you look at the sector performance just today on the trading terminal, you can see what performed well and what didn't. So you've got technology right at the top there, big performer today, and we already talked about that. And you can see that consumer staples, which is the the toilet papers and the shampoos, people like Procter and Gamble, they actually came out a little bit green today. But if you're looking at financials, energy, consumer discretionaries, are down there. Not quite as bad today as I would have expected, but a lot of the market did come back today. So
yeah, definitely. You got utilities and all that stuff. So let's go. I got a couple more slides. We talked about the bank's earning. We got over 110 people in our kind of show watching it. So if you could give us a thumbs up.
Awesome.
If you haven't already, I got to do this shameless plug, they call it. Profiting as active trader. Brian in this book talks about option trading, talks about swing trading, really treating it as a business. Over 300 pages. How many pages we got? Over 400 pages almost.
Yeah.
So, he worked really hard on this.
Lots of stuff in there.
Yeah, and he's very humble. He doesn't like this type of advertising, but I'll do it for him. It's not my book. I'll do it for him. I saw some really cool research that I want to talk about, Brian. I think you'll find a lot of value out of this as well. So this is a model on Bank of America. So this is Bank of America US and a quant strategy that they put out. So they're basically looking at a bunch of, they've done a regression, and they're looking at equity risk premium and normalized risk-free rate. So what is the risk-free rate at, and what is the equity risk premium? For those of you who don't know, equity risk premium is the difference between the expected return of the market. So I put it as RX here minus the risk-free rate, so RF. So this is a really important feature. So, if you have a lower equity risk premium, of course you're gonna have a bigger, SPX could be at 500. But the higher the equity risk premium gets, so the riskier the market gets, and at the same time the higher the rates get, this is kind of their terrible area where, a SPY could be at around 300, 320, 340. So right now their target for the year is 3,867. So if you want to turn it into a SPY, it's somewhere about 385 for a SPY. That's their year-end target for Bank of America, based on where the equity risk premium is and where the normalized risk-free rate is at. So I thought this is interesting. And by the way, we are experiencing one of the highest equity risk premiums in the last 20 years.
Interesting.
Yeah. I don't know, Brian. What do you think? Where do you think a SPY is gonna land? You got your magic 8-ball.
I kind of feel like I don't see a lot of downside from here. I mean, maybe we do get another flush, but then, I think that we'll start to turn and come back up towards the end of the year. So we may end up, maybe almost flat on the year.
Yeah.
I know some people are, analyst estimates are all over the place, right?
Yeah.
The expert estimates are all over the place. Some people say 4,100 on the SPY, and but for the most part, people are kind of, I think overall people are positive on the latter half of this year.
Yeah. Yeah, definitely. This is. I'm so glad you brought it up. One of the things you could do if you want to start a position and you're still a little scared and you want to maybe kind of buy right at the bottom is premium selling, sell puts. So one of the things I've been doing is I'm selling puts at 350 on SPY.
Right.
So that's another 10% drawdown. Even if I get a sign, that's a place where I'm really comfortable owning S&P 500 at 350.
Yeah.
Because as you said, in the latter half of the year we might rally. Maybe even in December we might get a Santa Claus rally, and you might close the year positive.
Yeah.
So you can sell some premiums, get paid while you wait. That's the beauty of the option market, right? Yeah. I know
so you just have to
that.
be prepared to, to get either you might have to get put those SPY, or you might have to close them out at a loss.
Yeah.
You don't have just because you're selling them doesn't mean you're not obligated to take them on. So
you can trade the contract, so you don't have to get a sign. You can do it a little earlier as well. Yeah. And
if you're selling them as even if the market does nothing, if you're selling them, the time value of them start to erode.
Yep.
As you get closer to the expiry date, so the value of those puts or the calls, whatever you're selling, starts to drop, and you can take 50% off the table as soon as you've got that much in your account, and let the rest run off, and just keep the premium, or just continue to partial out. Buy them back at a lower price.
Definitely. I got to give a shout out. One of the guys in the chat today, Reda. He was my university roommate, by the way. He's tuning in, so I'm so glad to have him on the show. And thanks for joining in. One other.
No, he wasn't a plant. He's a plant.
No, he's not a plant. No, he's joining himself. We were roommates during my UBC years. We were what a terrible. The housing in UBC is so bad. Brian, so bad. But we made the best out of it. Yeah. Okay. He was the one that always told me, let's go party and don't forget about your exams. Here I am.
He's a bad influence.
Exactly.
Yeah.
So another really interesting data that I saw was the M2 supply, money supply. Money supply is coming down.
Wow,
I mean, people are, we know QT hasn't even started, but massive decrease in money supply.
Yeah. Yeah, that's a really steep drop after a massive rise. So that's something that people watch as well.
Yeah, this
Money
could be
flow.
deflationary. So hopefully this will slow down the Fed. Brian, do you think there's like a 50% chance on a 1% increase rate in the next week? I think in the next 2 weeks when the Fed is meeting. Do you think they're going to do 1% or 75 basis?
I think in the context of things, I mean, the data that came out this week was certainly indicated a lot of inflationary pressure. A lot of inflationary things have been happening, but I think, you take a slightly higher level view and you look at all the things that have started to pull back, and you look at sort of consumer sentiment and what they're doing, cutting back on stuff, and you take the jobless claims that we just got this. I think the Fed's probably going to stick with 75.
Yeah.
I don't, and I think one of the Fed guys was talking, and he said he did say 1% was possible, but it kind of downplayed it. So it didn't sound like they were really going to be, putting the pedal to the metal, but certainly just keeping her going.
Yeah. I agree. I mean, if the Fed is really forward-looking and is looking at the data, they should do 75 basis points.
Yeah.
I personally think. I mean, you're already seeing the wealth effect. People forget the wealth effect. I mean, you look at your 401k, you look at your RSP in Canada, and like my retirement account, which is like self-managed, is one of those robots managing things that I don't even look at. I'm down like 15%. So that's my net worth, right? I'm worth 15% less, so I'm not going to spend as much.
Yeah, and certainly, I mean, again, getting back to this this survey that was done by All American, this census group, they, I mean, people are starting to use their credit cards more. I mean, I think, when we came out of the pandemic, a lot of people had a lot of excess money. They hadn't been traveling, they hadn't, bank accounts were pretty flush, and I think as we get through that with, and people are starting to use their credit cards again to make ends meet. That's never a good sign.
Yeah.
If you're using your credit card to pay for stuff that you can't afford at the moment.
Yeah.
So, you're seeing stuff like that. I mean, it's real. It's happening. It's not really anecdotal. So I'm not thinking the Fed's really going to come in and slam 1%, but certainly another 75 is probably a given.
Yeah, definitely. We got one last slides, and I want to talk about this. Bill Ackman, hell is coming. He took to Twitter and he said, this is from yesterday. So it says, in response to today's CPI print, which showed a broad-based and accelerating inflation, which, by the way, it didn't. I disagree with Ackman respectfully. I think the core CPI was still showing the signs that it's slowing down. Short-term Fed fund future move upward, implying a peak for Fed funds of 3.68 by end of the year. So holy, that's only like 3 more meetings, right? So how aggressive do they need to be? So basically they're saying they expect a more aggressive Fed will push us into recession by year end, and then has to cut again in response in 2023.
Right.
So and then he talked about how he compared this with 70s and 80s. So again, really critical of the Fed. He was one of those guys that said a few months ago that Fed has to do the right thing and like hike at like 1% or 2%. What are your thoughts? I mean, I know his fund is not doing very well.
Well, I mean, he's on a theme. He's obviously on a roll. He doesn't like Fed Powell. He doesn't like what he's done. And I mean, a lot of people are thinking, the Fed should have been more aggressive earlier.
Yeah.
They should have been hiking rates probably up to a year before they started doing it and started rolling off their balance sheet. But I think a lot of that is, it's easy to look in the rearview mirror and say, I should have done that. And yeah, I mean, that applies to just about everything. I'd love to go back and trade the market open again today. but
exactly.
It's easy to criticize someone when you've got, you've already know how history is played out.
Yeah.
So, I mean, I think the Fed did make a mistake, but, he's obviously got a bee in his bonnet, as they say.
Yeah.
And he's just using the Twitter platform to sort of, just get attention, and I don't know if it's not really helping anything anyway.
No, I know. People always talk about policy errors and stuff, but I mean, we had high unemployment right?
Yeah.
We were in a peak employment just until recently. So
yeah, and nobody saw I mean, I think the war was. I mean, nobody wanted to believe the war was going to happen in February.
Yeah, and people were thinking it's going to be done in 3 days, 4 days, and it's still going on, right?
Yeah, so, and I think, obviously I think that was a pretty significant driver of the inflation that we've seen. I mean, obviously it had a huge impact on energy, which, as we've talked about before, energy has a massive impact on just about everything. That we do. Yeah. Everything that we pay for in a store is touched by the price of energy. So that was something I really didn't see coming. So and it had a significant impact.
Yeah, and I don't think rate hikes is gonna bring down the gas prices.
No, unfortunately. But I mean, the idea that recession is around the corner. I mean, it's really taken the edge off of the energy market and the energy prices. I see we're down on crude. I think we're down well below 100 again today. So. Energy took a huge hit today.
What's your oil price target, Brian?
I don't know. I mean, they, there's real mixed, a real mix of opinions as to what's going on. Really don't have any idea where the bottom could be, and I've heard like bottom of $60,
yeah.
$70. I mean, getting back to close to the cost of production.
Yeah. So 2019 it was 60, right? So 2019 before the pandemic it was around the 65. But we just went through the bank's earning and people are saying, hey, demand is higher than 2019, 25-30%. So, I mean.
Yeah, and then you got China, throw China in there. That's been a weird one too. I mean, again, nobody kind of expected the problems that they've had in China with and the Chinese government's reaction to the pandemic. Every time there's a couple of cases, they shut down a city. Yeah. Adds to supply chain issues. Yeah, exactly. And again, drives the price of stuff up and shortages and stuff like that. So it's there's a lot of weird things going on in the world that are affecting the prices of things and really outside the control of the Fed and pretty much everybody else. Yeah.
So we closed the market, SPY down a slightly 25 basis point. NASDAQ closed green, 36 basis point.
Yeah.
Dow, 44. Russell, again, the weakest index. I've talked about how these guys are the definition of cyclicality. So do not touch IWM. You might think they're cheap, but it could get cheaper. There's a reason that they're cheap. So again, another bad day for IWM.
But not all bad days are the same. I mean, you can look at the IWM index, and it did finish very well off the lows of the day. So again, the markets overall. I mean, I think it was actually a pretty decent day, given the Dow was down. Was it down like 600 points at one point?
Yeah. And
it still finished down 300, but that was a pretty significant comeback. And the Qs again, in the SPY really just fractionally in the green, in the red. So not a bad day overall in the markets, actually.
No, yeah. Not a bad day, another day. So giving you, today's gonna be our last session of the week. We don't have any show tomorrow for you. I just wanna give you a little bit of kind of introduction to our guest next Thursday. So we have Jared Dillon coming on the show. He has published 2 books. The first one is The Street Freak, and the second one he published in 2016, All the Evil of This World. So he's a columnist for Bloomberg. He was a trader for Lehman Brothers up until 2008 when Lehman Brothers collapsed. So he's an institutional trader. He has plenty of experience, more than like 60,000 followers on Twitter, columnist again on Bloomberg. He's a really awesome guy. He's coming on the show. We're gonna ask him some amazing questions. Of course, he's trading his own money right now. We'll talk about him, about the market, what's different from what is the difference from the institutional level versus what's going on kind of in the retail world. And yeah, it's gonna be an awesome conversation on next Thursday. So definitely tune in. And one of the things that I would genuinely ask you guys is, the more you like these videos and the more these videos get recognition, the higher quality guests I can bring, because I can leverage previous guests and go get the better guests. So, last week I was having a conversation. I said, I won't be surprised if we can get Kathy Wood next year.
Yeah.
Right? With the speed. I don't know if it means much.
We'll just have to make sure Zoom video subscription is paid up. So
Definitely. No, we're using our own software, so we're using the vMix software.
No, I was kidding. I think that
it was a great joke, by the way.
Yeah, I think it was a CNBC thing, but but it was kind of funny when it happened.
Yeah, it was hilarious. But yeah, we're gonna continue to bring amazing guests for us. If you want someone on the show, let me know. Message me, email me, tell me, hey, get this person on the show. I'll reach out to them. Working really hard. Carlos, who is in the chat, shout out to Carlos. He's working really hard bringing these guests for our show. Of course, check out Trading Terminal right here, right over here. So Trading Terminal is the website we're building ourselves for the traders. We're still in the beta version. I know we got problems, but trust me, we are working really, really hard to solve all of those issues. And in August, we're actually remodeling and revamping the whole platform again. So, yeah, bring President Biden.
Yeah.
We'll try. We'll try.
Yeah, that'll be a few more likes, I think, before we get there.
Yeah, we need some bot accounts to like the videos. Yeah.
Well, we want Elon on. I'd love to have Elon on.
Oh, I would love. We could totally bring Elon. Yeah. I would love to know how he got paid $25 billion last year.
We could smoke a doobie with him.
Smoke a doobie, 100%. Yeah.
Oh, maybe not.
Any last word from you, Brian?
No, it'll be an interesting day tomorrow. We do have some more banks coming up. Citi, I believe, Wells Fargo. I'm not looking at the thing, but I'm.
Oh, actually, that's a great point. Let me go to our earnings. Here. Yeah. So we got Wells Fargo, Citi. We got PNC, BlackRock is.
Yeah, BlackRock's interesting.
Those guys are reporting.
U.S. Bank, Corp. Yeah, and then of course next week should be quite interesting with Tesla and.
You got Goldman, you got J&J, you got Netflix, you got Interactive Broker.
Yeah, CSX. Lots of fuel or lots of fodder to.
Lots of heavy hitters.
Yeah.
Yeah. You know how Thor has this thing, day traders, this hunting season, option traders. This is your dream. So get into trading mode and
looking at option trades like we talked about at the beginning of the market show here, looking at those outsized moves and then establishing a bottom or a top, and then selling option premium.
Yeah, that's the way to do it.
Yep.
With that brings our show to an end. Another amazing week. We had phenomenal guests. We had a lot of fun with Brian. Thanks for coming. Andrew's coming back next week, but we should get you more on this show.
Yeah, no, I'm always happy to come down and be part of the show. It's a lot of fun here.
Yeah, I appreciate it. Thank you.
All right.
And thanks everyone. We'll see you next week. Trade safe, stay liquid in this market. Okay?
Yeah.
Stay solvent.
Have a good one, everyone, and we'll see you in the room tomorrow, bright and early.
See you.
Bye now.
Bye.